What is going on, everyone? Marc Guberti here. In this video, we are going to talk about options on Fidelity. How do we buy and sell calls and puts? I'm going to just show you a brief overview of that. A lot of people that do get started with options, they just think of buying calls and puts. And while this strategy can produce a lot of money, you could also lose all the money that you put into it. So buying calls and puts, it isn't the only thing you want to be doing with options. And I only recommend the buying calls and puts if you want to use it more of a hedge. There is, maybe you've heard of Wall Street Bets, the Reddit group where people put all their money into a single call or put, hoping it goes their way. I do not recommend that, but I think it does make sense to buy calls and puts if you want to use it as a hedge to protect yourself if your portfolio suddenly swings in one direction. So when it comes to options on Fidelity, first you have to apply for the feature. It's not something that Fidelity readily gives to everyone because you do want to understand the implications of making that type of investment, because while a stock, you just buy it and it goes up or it goes down, options have a limited shelf life where they will expire at some point. And if they expire at below the strike price, it becomes completely worthless. If it expires at the right spot, then the order gets executed. So when it comes to using Fidelity, when you do get options on your account as a feature, you will be able to trade those options similarly to what you would do with going into trading a stock. So when you do try to trade an option, you will see 5 different options. And we're using big commerce in this example to illustrate. The first, buy to open. What buy to open means is that you just want to buy a call or a put. In this case, I have it set to call. And in this case, you just get the contract. It's pretty much what you would expect when it comes to options trading. The second option is buy to close. So maybe you did a covered call, which we'll talk about a little bit later, and you want to buy a call to cancel out the sell call based on setting up the covered call. So in buy to close, sometimes people do that because they want to lock in a gain or they want to protect themselves from having to sell the 100 shares and possible tax implications. So that's why people will buy to close. Sell to open is if you already have the 100 shares in the case of a call, or for a cash secured put, you have the money available already. So for covered calls, sell to open, you have the 100 shares. For the cash secured put, you have $2,000 and your strike is $20. So that's how those two work. So sell to open, you are collecting the premium rather than paying money to have that contract. This is where we get to the concept of passive income when you do decide to sell to open. And sell to close, that is when you buy to open at first. So you're just buying the put or you're buying the call and you're hoping it will rise up in price, and then you sell to close. This is something you will have to do if you do not plan on executing the call, where you get the 100 shares at the certain strike price. If you're someone who maybe you bought the call and you can't afford the 100 shares and you're just hoping that the contract, the value of that goes up, you would have to sell to close at some point, because at some point all these contracts are set to expire. And finally, we have specific shares, and this is for people who have over 100 shares in a company, because some shares you buy at different times, which means some of them are going to have different tax implications. Selecting specific shares can protect you from selling the stocks that have a 50% gain and then having to sell the stocks with only the 10% gain rather than the 50% gain. So if you have a stock that you want to do covered calls with, and you want to make sure you don't sell the ones that have the biggest tax implications, you can select specific shares of those companies to ensure that you are selling the ones with the least tax implications. One really useful resource Fidelity gives you is the options chain. And you could also get this on Yahoo Finance. You could do this for any stock. I like the Fidelity one better because it also gives you the ability to buy the calls, buy the puts, and sell the calls and puts, and basically do everything within that one place while getting all of the research you need. So I'm actually going to pull up an example. We're using Big Commerce again. And as you can see, we have two expiration dates that are up on the screen. We have September 18th and we have October 16th. And the further you go out, you will notice that all those premiums are a little bit higher because as you can see with September 18th, the expiration, it's just 15 days, while October 16th expiration, that's 43 days away. So you do have to hold on to the stock longer for October 16th versus September 8th, which is why the premiums are higher. And similarly, if you are buying a call or put rather than doing the selling, you will have to pay more because a person on the other side of the transaction does have to hold on to the stock longer, which certainly means a little bit more risk. The options you pick will depend on your overall strategy. For Big Commerce, you could get a quick return around 10% by picking a contract that expires very soon. The risk is you do have to hold on to it. And Fidelity, this is something they do that I haven't seen Yahoo Finance do. They let you know when the earnings dates are. So the reason in part why these are really high premiums, not just because the stock just recently came out of an IPO and its price is moving around a lot, but they also have earnings coming up very soon. And after earnings hit, all these prices are going to have very big swings in one way or the other. Now, some people who do covered calls and cash secured puts, they don't really want to lose the shares or end up buying the shares through the cash secured put. So if you're someone doing covered calls and you don't want to give up the shares, then you could set the strike price at a price where it probably will not hit. Now, it's better to just not proceed with covered calls if you are that afraid of losing the shares, especially if there are big tax implications. But if you do buy 100 shares of a company, you do this just recently, and you just want the gain, you want something like a 5% gain in the course of a week, then it would make sense to pick a expiration date that is a little bit sooner and does give you that quick premium. So in the event that you have to sell the 100 shares, you get a nice percentage boost to your portfolio. If you end up keeping the 100 shares, you just end up doing it all over again with another covered call. Cash secured puts, very similar. Let's say you do $2,000, strike price of $20, and the stock goes down to $19, then you buy the stock at $20 a share because that's the obligation of the contract, even though it's $19 a share in the marketplace, but you do get some premium for doing that, which could offset losses. Then to get out of that position, you could do a covered call that is very close to being in the money. If for a cash secured put, let's say $20 strike price, $2,000, it goes up to $21 per share, then you eventually get all of your money back and you do end up keeping the premium. You could keep doing cash secured puts until you end up buying the shares and then do a covered call to get yourself out of it and continue to make premium along the way. This is actually a strategy that will make you far more money for dividend stocks with the premiums versus the actual dividend yield. So you can see Bank of America, which we will be showing up right here. The premiums on that are more than the entire annual dividend. Right now, Bank of America's dividend is just 18 cents per quarter. You could pick one of these premiums and make even more money than you would make for the whole year with the dividend. And you can even set the strike price where if the order is executed, you will still see some appreciation. So let's say, for instance, you have a stock and it's $30 right now. You set the strike price at $33. That's still 10% appreciation in addition to the premium that you collected through that option. So there are a lot of different ways to play with calls and options. You do have to apply on Fidelity to get them first, but I just wanted to create this video for people who aren't really sure what the whole dashboard looks like and the different capabilities they have when it comes to buying and selling different options. So in any event, I hope you guys enjoyed this video. Let me know if you want more like this, and I'll see you guys next time.